Okay, so we have this question here for this company, Joba Limited. All right. Yes. So part A is asking us to find the weighted average cost of capital. So this information here in this second paragraph, the only information we need for the weighted average cost of capital. Okay. So first I'll read the second paragraph and get that information to solve. Okay. This information in the second paragraph. Okay. So Joba Limited has 10 million kwacha ordinary shares issued at par value of 1 kwacha with a market share price of 12 kwacha. The firm has just paid a dividend of 2 kwacha 60 ngwe per share, and 5 years ago the firm had paid a dividend per share of 1 kwacha 10 ngwe. The firm has a 10% bond amounting to 4 million issued at par value of 1,000 kwacha with 5 years to maturity, currently trading at a market price of 1,095 kwacha. Corporate tax is 30% per year. So we're dealing with part A. Calculate the weighted average cost of capital, rounded off to the nearest whole number. So weighted average cost of capital, the overall cost of financing to the company, with a minimum required rate of return to the providers of capital, who are the shareholders and the creditors. Okay. So let me explain some of this information here. This 10 million kwacha, this is the money raised from selling shares. Okay. The par value of the shares is 1 kwacha. When the shares were issued, was their worth, 1 kwacha. Now, these same shares are trading for 12 kwacha. Okay. They are now trading for 12 kwacha on the securities exchange. Okay. Uh-huh. Then here for the bonds, this 4 million has been raised from selling bonds, corporate bonds, not government bonds, colleagues. It's a corporate bond. 4 million has been raised. The par value of the bonds is 1,000. Remember, par value, this is what you're paid when the bond matures. These bonds are selling for 1,095 kwacha. They're selling at a premium. Okay, when the price of the bond is greater than the par value, the bonds are selling at a premium. Okay, so with Wacc, these are the steps you need to take. Step one, okay, get the market values of equity and debt. Okay, that is the first step. All right. These market values, we're using the technique of company valuation, which is called market capitalization. Okay, market capitalization, how you find the value of a company is just the number of shares times the share price. That will give you the value of equity. That's the value of the company. Okay. So to get the market value of equity, here's the formula here. VE, market value of equity, number of shares multiplied by the market price. We haven't been given the number of shares. They've just told us that it's 10 million kwacha and the par value of the shares is 1 kwacha. So to get the number of shares, colleagues, it is the ordinary share capital divided by the par value. The ordinary share capital is that 10 million kwacha we saw in the question. The par value of the share, 1 kwacha. So 10 million divided by 1 kwacha, we have 10 million shares. Joba has 10 million outstanding shares. So we want to find what is the value of equity for this company. Okay, according to the stock exchange, what is the value of Joba Limited? the value of equity. So number of shares, 10 million shares multiplied by the market price. Each share is going for 12 kwacha. So 10 million times 12 kwacha, you get 120 million. Okay, that is the market value of equity. Any questions before I go to market value of debt? Mhm. Yes, to get the number of shares, it's the ordinary share capital divided by the par value only. Don't include market price. No, 10 million. Yes, 10 million shares. Yes, yes. So remember, this is also a valuation technique for valuing a company, market capitalization. Okay, just the number of shares the company has multiplied by the market price. Okay, so next is market value of debt. Okay, so these formulae are in the same format. Okay, the market value of debt is the number of corporate bonds multiplied by the market price. Now, in the question, they haven't given us the number of corporate bonds. They just told us how much has been raised from selling these bonds and the par value. So, in order to get the number of corporate bonds, it is the value of debt divided by the par value. Okay. Here, the value of debt they told us in the question is what? 4 million kwacha. Par value 1,000. So the number of bonds, 4 million divided by 1,000, they have 4,000 bonds, 4,000 corporate bonds. Okay. So the market value, number of bonds, 4,000 bonds times the market price, 1,095, 4,380,000. Okay. So this is the value of Joba's debt according to the stock exchange or the securities exchange. Any questions? Question. From the question, value of debt 4 million, per value 1,000. It's there in the question. Yes, it's the price of the bond, sir. Okay. Then you just say the bond is selling at a premium. 4 million. So 4,000 times 1,095, 4,380,000. That is the market value of debt. That is step one. Okay? And this is where, after this step, I would advise you, this is where you also get the weightages. Okay? After you get this market value of debt and market value of equity, this is where you get the weightages. Okay, the weightages give you the capital structure of the company. Okay, it tells you what percent of equity financing is the company using and what percent of debt financing is the company using. That's what the weightages tell us. Okay, so what you do first, add up both market values. Okay, 120 million times 4,380,000, 124,380,000. Okay, this is the total financing. So one find what is the weightage of equity. So you see 120 million divided by 124,380,000. You get 0.96. Okay. Let's check with our calculators. 120 million divided by 124 million, 380,000. We're getting 0.96, which is telling us 96% of Joba's financing is equity based. Okay. And the weightage of debt, 4,380,000 divided by 124,380,000 gets 0.04. 0.04, yes, which is telling us 4% of their financing is coming from debt. Okay. So these weightages are the ones we're going to use in the formula for the work. Any questions before we go to step two, which is calculating the cost of equity and the cost of debt? Hmm. Yes. When you add this one, when you add these two numbers, 120 million plus this. Okay. Step two, calculate the cost of equity and the cost of debt. Okay. So cost of equity, as I said, there'll be two scenarios. Either scenario one, you're using the dividend growth model, or you'll be using the capital asset pricing model. It depends on the information that you've been given. So here, just because they mentioned dividend, the dividend of 2.6 has been paid 5 years ago, and then, or a dividend of 2.6 has just been paid, and 5 years ago, dividend of 1.1 has been paid. So we're using the dividend growth model, okay, to calculate the cost of equity. Okay, we remember this formula here, colleagues. This one here, do we remember this formula? Yes, this is the formula we're using. But notice, we haven't been given a growth rate. So you need to get the growth rate to determine the growth rate by yourself. So this is the formula you're going to use to get the growth rate. Okay. The growth rate equals number of years, the root over the latest dividend over the earlier dividend minus 1. Okay. They told us 5 years ago, in the question here it says 5 years ago a dividend of 1 quarter Tenungwe was paid. So N is 5 years. The latest dividend, 2.6, which has been paid, the current dividend, which has just been paid, 2.6, and the earlier dividend, 1.1. Okay, so we are going to put like this. The root of 5, 2.6 divided by 1.1. Colleagues, here we're just calculating the growth rate, okay? Yes. Mhm. Number of years. Okay. So 2.6 divided by 1.1, that is 2.36. Okay. Now on your calculators, you might not find this, the fifth root. Okay, so what you can do is this, just applying laws of indices, you convert this root into an index, into a power. Okay, that's why you've seen here we've written 2.36 to the power 1 over 5. This 2.36 to the power 1 over 5 is the same as the fifth root of 2.36. We have just used laws of indices. Okay, colleagues? We have just used laws of indices so that we can put this in our calculators. Okay? Is that okay, Mr. Kasono, Madam Yvonne, Mr. Nelson, Mr. Nchimonia, Mr. Dennis? Yeah. So this one, 1 over 5 is the same as 0.2. Okay? So it's a 2.36 to the power 0.2. Okay? If you want, you can say to the power 1 over 5. Okay? 2.36 to the power 0.2, we get 1.187. Any questions before I move further? Okay. 1.187 minus 1, 0.187. We convert it into a percentage, 18.7%. Okay. That is the growth rate, 18.7%. So when a growth rate hasn't been given to you in a question, just use this formula, okay, colleagues, to get the growth rate. All right. So now we can find the cost of equity using our formula here for the dividend growth model. Remember, DO is a dividend that has just been paid, which is 2 quarters 16 well, multiplied by 1 plus the growth rate. Our growth rate is 18.7%, which is 0.187, divided by the market price of the shares, PO, 12 quarter here, plus the growth rate, 0.187. Okay, so you're going to say 2.16 multiplied by 1.187, you get 3.08. 3.08 divided by 12, you get 0.25. Okay. 0.25 plus 0.187, you're going to get 0.44, which is 44%. So the cost of equity is 44%. Any questions before we go to cost of debt? All right. Next, we need to get cost of debt. Again, with cost of debt, you have two scenarios: redeemable debt and irredeemable debt. Now, when they give you the years to maturity, then that you're dealing with redeemable debt. So that's where you need to use either the internal rate of return (IRR) to get the cost of debt, or you can use this formula, the yield to maturity formula, to get the cost of debt. The years to maturity. You can use the internal rate of return to get the cost of debt, or you can use this formula for the yield to maturity to get the cost of debt. So in the exam, it will be to your best interest to use this formula. Okay. Okay, so to get our cost of debt, it's just the interest payments multiplied by 1 minus the tax rate, okay, plus the face value minus the price of the bond over the number of years to maturity of the bond over the face value plus price over 2. Okay. Yes. So the interest payments equals interest rate multiplied by par value. The interest rate is 10%. The par value 1000. 10% of 1000, 100 kwacha. Okay. Mm-hmm. Yield to maturity. What that means, it just means that's your total return if you hold the bond until it matures. That's what yield to maturity means. So you can use the formula for the yield to maturity to get the cost of debt, redeemable debt. So these interest payments, you multiply them 1 minus the tax rate. Colleagues, remember what I said? The more debt, when you take on debt, you pay less in taxes. Okay? That's why you see this 1 minus t there. Okay? You pay less in taxes the more debt you get. Okay? So our tax rate is 30%. So as you can see, 100 multiplied by 1 minus 0.3 plus the face value or the par value of the bond. The par value of the bond is 1000. The price of the bond 1095. Number of years to maturity 5 years. Over the face value again, or par value. Since in this question they use par value, so let me put par value. because people get confused. Where is this face value coming from? Isn't that right, Mr. Kasono? People be confused. Where is it? In the question, and do you see any face value? And those are getting calls now at 02. So, well, how do you get face value? Yes. So we do our tabulations. 1000 minus 1095, you get negative 95 over 5. This 1 minus 0.3, you get 0.7. 1000 plus 1095, you get 2095 over 2. Negative 95 divided by 5, you get negative 19. 100 times 0.7, you get 70. 2095 divided by 2, 1047.5. 70 plus negative 19, you get 51. 51 divided by 1047.5, you get 0.04869. Okay, which you can round off to 5%. Okay, which you can round off to 5%. Okay. Any questions, colleagues? Are we enjoying this? Are we going to attempt this in the exam? Mm-hmm. Mm. Yes. Yes. So you're just confused over where the tax rate came. So I've seen what's confusing you mostly is where these figures are coming from. Colleagues, remember every figure that you see me putting is in the question. Okay. I'll never have to assume or guess a figure. Okay. Yes. So that is our cost of debt. Okay. So we can get our weighted average cost of capital. Here's the formula for the weighted average cost of capital. Let me put it properly here. It is the weightage. So here, let me put it in words first, then symbols, so that we follow through. Okay. So in words, it is the weightage of equity multiplied by the cost of equity. Okay. Plus the weightage of debt multiplied by the cost of debt. Okay. Remember, this is the after-tax cost of debt. When we say after-tax cost of debt, meaning we've already did this 1 minus t here. Okay. Then this now simplifies to this. So the weightage of equity, it is the value of equity, VE, over the value of equity plus the value of debt. So these weightages, we already tabulated them in step 1, okay? Multiplied by KE. K is cost of equity. Plus the weightage of debt It is VD over VE plus VD multiplied by KD 1 minus T after tax cost of debt. Okay, colleagues? Very consumer friendly, right? So the weightage of equity, come back here. Weightage of equity 0.96. Cost of equity 44%. So we're going to say 0.96 multiplied by 44% plus the weightage of debt 0.04. Remember, the weightages always have to total up to 100% multiplied by the cost of debt 5%. Okay. So we're going to say 0.96 multiplied by 44%, you get 42.24. 2.24% plus 0.04 multiplied by 5. 0.04 multiplied by 5, you get 0.2%. 44.24 plus 0.2%, you get 42.44%. 42.44%. Okay, so this is the weighted average cost of capital. Okay, and this is what we're going to use as our discount factor for this question for Job.